This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
Oil output in Russia, the third largest producer in the world after the United States and Saudi Arabia, is expected to be steady or even to increase next year as Moscow has largely overcome Western sanctions, analysts said. The government has said that Russian oil and gas condensate production is set to decline to 527 million metric tons, 10.54 million barrels per day, this year from 535 million tons in 2022, as Moscow has restrained supply in line with its agreement with the OPEC Plus group. According to the poll, Russia may produce between 515 million tons and 538 million tons of oil next year, while exports will be broadly unchanged, at 250 million tons.
Oil prices steadied on Thursday after falling sharply in the previous session, as concerns eased about shipping disruptions along the Red Sea route even as tensions in the Middle East continue to rise. Brent crude futures inched up 10 cents, or 0.1%, to $79.75 a barrel by 0424 GMT, while US WTI crude futures were trading 5 cents lower at $74.06 a barrel. Prices dropped nearly 2% on Wednesday as major shipping firms began returning to the Red Sea. Concerns about shipping in the Red Sea have eased, but continued worries about tensions in the Middle East, especially on Iran's involvement in the region, make it difficult to sell further, said Hiroyuki Kikukawa, president of NS Trading, a unit of Nissan Securities.
Moving on to the top news in the energy sector.
US sanctions targeting Russia's massive Arctic LNG 2 project are unacceptable and undermine global energy security, the Russian Foreign Ministry spokeswoman said on Wednesday. The project, located in the Gudan Peninsula in the Arctic, is a key element in Russia's efforts to boost its share of the global liquefied natural gas (LNG) market to a fifth by 2030 to 2035 from 8% now. Western countries have imposed wide-ranging sanctions against Russian firms and individuals following the Kremlin's decision to send tens of thousands of troops into Ukraine in February 2022, seeking to cripple Moscow's military might. Last month, Washington announced sanctions against Arctic LNG 2.
Diesel supply in Asia is set to jump in 2024 fueled by new refineries in the Middle East and robust exports from China, and is likely to outpace the region's world-leading demand growth, analysts and trade sources said. As a result, diesel prices are expected to fall, meaning Asia's refiners face a second consecutive year of sliding profit margins for the fuel used in cars, trucks and power generators. In 2022, average diesel profit margins soared to an all-time high of $45 a barrel, as supplies from top exporter Russia were disrupted and global inventories sank to a record low. Next, we have the top news in metal markets. China's top copper smelters lowered their first quarter guidance for copper concentrate processing, treatment and refining charges, TCRCs, as mine closures and disruptions tightened the supply outlook. The rates, decided at a meeting of the China Smelters Purchase Team, CSPT, held on Thursday, were $80 per metric ton and 8 cents per pound, three sources with knowledge of the matter said. The first quarter guidance was down 16% from fourth quarter guidance of $95 per ton and 9.5 cents per pound, a 6-year high.
Dalian iron ore futures declined on Thursday as the Chinese yuan strengthened, although discussions about China's economic recovery through stimulus measures limited the losses. The most traded May iron ore on China's Dalian Commodity Exchange was down 0.4% at 975 yuan and 50 fen, $136.95 per metric ton, as of 0315 GMT. On the Singapore Exchange, the benchmark January iron ore was down 1.2% at $139.55 a metric ton, snapping a 5-day winning streak.
We will now look at the top news in the agricultural sector.
China has approved a first batch of seed companies to breed and sell genetically modified corn and soybean seeds, paving the way for commercial planting of GMO grains in a move that could cut its reliance on imports from the US and Brazil. The Ministry of Agriculture and Rural Affairs, in a notice dated December 25, issued licenses to 26 local companies to produce, distribute and sell the GMO seeds in certain provinces. The companies named include Beijing Dabainong Technology, subsidiaries of Yuan Longping High-Tech Agriculture, and China National Seed, now owned by Syngenta Group. That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.